Welcome back to the Capital Mindset. I'm your host, Alex, and today we're tackling a subject that almost everyone gets wrong when they first step into the markets: risk management. You see the headlines about those huge exponential returns, but the reality is most beginner investors, we're talking about 90%, end up losing money. And the reason isn't bad luck or bad market calls, it's something much simpler.
Exactly, Alex. It's often not about the engine, the investment itself, but the lack of brakes and seatbelts. It's fantastic to dream of that early retirement, but the road to volatility is brutal if you don't prioritize protection over profit. My professional experience has shown that the biggest destroyer of capital is poor or sometimes completely absent risk management. It's the silent killer of portfolios.
That's such a great analogy, the brakes and seatbelts. So let's set the context. Why is this topic, risk, not returns, so crucial in today's environment, where everything seems amplified, from social media hype to market swings?
I think the biggest change is access. Everyone is a trader now. You can open an app and trade leverage or complex assets in minutes. This democratization is great, but it fuels a mentality that confuses strategic investing with gambling. They look at the price action like a slot machine: adrenaline when it goes up, panic when it goes down, and that's the first fatal error we see.
Right, they're making a high-stakes bet instead of executing a disciplined plan. Can you walk us through the first major structural mistake they make when they approach a trade?
Absolutely. It's error number one: trading without a defined strategy. Think of yourself as the captain of a ship. Would you sail out without a map, a destination, or a plan for a storm? Of course not. But thousands of people buy assets every day without defining three simple things: entry criteria, why am I buying now? Exit criteria, where is my stop loss and my take profit? And crucially, capital management. How much of my total account am I risking?
That seems so obvious when you say it, but in the heat of the moment, I can see how you just hit buy.
You do, and without a written plan, your decisions are just impulsive reactions to price. That journal you mentioned in the source material, it's key. Record the reasons for the trade, not just the result. That's how you remove the emotional fog.
Core discussion, the 6 fatal mistakes. Let's move on to what separates the professional investors who last from the amateurs who disappear. You mentioned leverage. Error number 2, excessive position sizing. This seems like the fastest way to blow up an account.
It is. Leverage is that double-edged sword. It amplifies gains, but it exponentially amplifies losses. Beginners, motivated by the get-rich-quick stories, maximize positions. They don't calculate risk based on the total leveraged amount, but on the actual capital they stand to lose. A 1% adverse move can wipe out 10% of their account. For a novice, the advice is simple: avoid leverage entirely or use it with extreme moderation. Your number one job is capital preservation.
That leads us right into the emotional labyrinth of trading, which I think is 80% of the game: fear and greed. Error number 3, not respecting the stop loss. This is literally the life insurance for your trade, isn't it?
It's the single most important defensive tool. Not using one is driving without brakes. But even worse is moving the stop loss. I've seen this countless times. The stock drops to the stop loss level, say $95. The trader says, "Oh, it's just a pullback, I'll move it to $93, then $90. Before they know it, they're down 30% of their capital because hope fought and lost against market reality.
So the rule is set it and forget it. Trust the plan.
Precisely. If the loss triggers, your analysis was wrong, and the stop loss saved you from a far greater problem.
And what happens right after that stop loss triggers? That leads to error number 4, loss vengeance or revenge trading. This is where the emotional self-sabotage peaks, right?
It's the toxic manifestation of frustration. You've suffered a loss, and instead of accepting it as an operating cost, you feel this urgent, burning need to recover the money immediately. That looks like increasing your position size way beyond your limit, ignoring your entry rules, or trading instruments you've never touched before, seeking that big move.
I can picture that moment, the adrenaline high of trying to fix the mistake.
The expert investor knows the best risk management after a significant loss is simple: close the platform and take a break. Break that emotional cycle. The market will still be there tomorrow.
Allocation, liquidity, and macro. Let's shift from trade mechanics to portfolio structure, because risk management isn't just about the stop loss, it's about allocation. Error number 5, extreme concentration, the classic all or nothing bet on the next big thing.
The basket metaphor is perfect here. If you put all your eggs, 50, 80%, 100% of your capital, into one asset and that basket falls, you lose everything. Diversification is the only free lunch in finance. You need to diversify geographically, sectorally, and by asset class. Don't just buy 10 different tech stocks. You need healthcare, energy, bonds, maybe some real estate. This protects you from the specific, unsystematic risk of one company or one sector blowing up.
That's a crucial distinction. It's not just buying different tickers, it's buying different types of risk. And finally, let's talk about the foundation of personal finance. Error number 6, investing money you need in the short term.
This is about personal liquidity risk. If you allocate money that should be your emergency fund, your 6 months of expenses, or money for a near-term payment like tuition, into a volatile investment, you're setting yourself up for failure. If the market dips 20% right when you lose your job or your car breaks down, you are forced to sell at a loss. The investment didn't have time to recover. Only invest surplus capital, money you can genuinely afford to let sit for 5 to 10 years or more.
Practical application and mindset. Fantastic summary of the 6 flaws. Now, for the actionable takeaways. If I'm a beginner listening right now, what's the single most important rule I should implement today to shield my capital?
It has to be the 1% or 2% rule per operation. This is the golden rule of professional capital management. Never risk more than 1 or 2% of your total capital on a single trade.
Let's make that really concrete. Say I have $10,000 portfolio.
Okay, 10,000. Your 1% risk maximum is $100. If you buy a stock at $50 and set your stop loss at $48, that's a $2 risk per share. You can only buy 50 shares. If the trade fails, you lose exactly $100. This rule gives you a monumental margin of error. You could fail 50 times in a row before losing half your account. It takes the stress out of single trade.
That's a huge difference psychologically. It allows you to focus on the process, not the outcome.
Absolutely, and that leads to the mindset. You have to cultivate discipline and resilience. Accept losses as operating costs, not personal failures. Practice patience. Money is often made by waiting for the perfect opportunity, not by trading constantly. And please, please avoid relying totally on outside advice. Use the internet guru as an input, but subject it to your own risk analysis.
That's a solid point on authority. You need to understand why you're doing something, not just what someone told you to do. And finally, you touched on macroeconomics. Why is it important for the average retail investor to track things like inflation and interest rates?
Because the market doesn't operate in a vacuum. Inflation is like the tide, constantly eroding your purchasing power. When the Federal Reserve raises interest rates to combat inflation, they make borrowing more expensive. This hits growth companies that rely on cheap debt the hardest. If you're a novice, you might be buying those growth companies right when the Fed is tightening. An expert understands the underlying narrative, anticipating the risk of economic contraction. It's about knowing the story behind the price.
That is such a powerful framework. To quickly recap the core lesson, success in investing is measured by how much money you protect, not how much you earn. We've talked about the importance of a written plan, respecting your stop loss, avoiding revenge trading, and the absolute necessity of the 1 or 2% rule.
And remember, expertise isn't about avoiding storms. It's about having a strong ship, your protected capital, and an accurate compass, your risk plan. By implementing these principles, you move from being a random amateur to a disciplined financial strategist.
Well said. Thank you so much for breaking down these fatal mistakes and giving us a clear roadmap for protection.
My pleasure, Alex. Happy trading, everyone.
And thank you all for tuning in to the Capital Mindset. We'll catch you next time.